let's look at NVIDIA first. Let's get to our first one. Now, what we're doing, if you choose to use a strategy like a diagonal spread, other than for bullish purposes, you have to be careful of long vega, right? Buying a further out date, selling a shorter date gives you long vega. So what you do to combat that or to minimize that, is to move those dates as close to up as possible. Okay, so we're looking at NVIDIA buying the March 28th 107 call, but right at the money, and then selling the March 14th 112 call. Now you can go even tighter than that, but this is a fair amount of space between the two trades. It does give you $5.70 of long vega that you have to be cognizant of. That's risk if overall implied volatilities come down. The good news is, if implied volatilities come down, it's probably because the market's rallying and the 107s would be more and more in the money. So there's that trade-off, but beware of underperformance on the upside due to implied volatility if it were to start coming down off its lofty levels. Just something to think about. So buying the March 28th 107 call, selling the March 14th 112 call. The debit we have is about 520. It's trading about 510 now. The risk on the trade is the debit paid, and you're looking for, in the next just 3.5 trading days, a move up towards that 112 strike, and that's just slightly lower than the expected move, being a little more aggressive with our short strikes. In this case, $5 wide call diagonal in NVIDIA. Remember, the risk on the trade, the debit paid. The target on this trade is the short strike, in this case the 112 strike, expiring on March 14th. That's this Friday.
NVIDIA just hit its lowest valuation since before ChatGPT launched, with its price-to-earnings ratio sliding to levels not seen since 2019. With a 30% decline from its top, the stock's projected PE is now 24 by 41% less expensive than it was before AI craze began. Analysts, however, are not in a panic. Given NVIDIA's 788% net income increase since fiscal 2023 and the ongoing AI boom, Melius Research and Wells Fargo both view this as a classic buy-the-dip situation. Given the robust demand for GPUs, this sell-off may be paving the way for yet another significant surge. The GPU Technology Conference next week is escalating the conjecture. It is anticipated that CEO Jensen Huang will present a 2027 roadmap that includes innovative developments such as co-package optics and the new Blackwell Ultra GB300 inferencing CPU. Updates on NVIDIA's software monetization, networking enhancements, and automotive growth will also be of interest to investors. The stock has a history of outperforming around GTC, averaging 6.4% during the event, and an additional 4.5% in the 2 weeks that follow. This might be the setup bulls have been waiting for if that pattern continues. Melius Research remains steadfast in its $170 price target, while Wells Fargo goes even higher at $185, both suggesting substantial upside. With AI adoption still in its early innings, investors betting on NVIDIA's future may soon look back at this dip as a golden opportunity. Some analysts are comparing NVIDIA's current discounted valuation to Apple's valuation crunch following the 2008 iPhone launch, when skepticism gave way to explosive long-term growth. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Let's take a look now at chip stocks. NVIDIA leading those names lower today, extending those losses fueled by tariff and AI spending fears. The chip giant has already shed $1 trillion in value since hitting a fresh record high earlier this year. And when it comes to the NVIDIA story, obviously a huge run, right? Up 800% in 2 years, but several factors colliding at once that make the sell-off that we're seeing sort of make sense when it comes to tariff uncertainty, export controls from the Trump administration. Then you've got DeepSeek pointing to questions about whether or not the amount of money that these hyperscalers are spending on AI is actually necessary. Could that be a downswing for NVIDIA's sales? And then you've got the overall question of economic growth moving forward. All of that creates a scary soup when it comes to the NVIDIA story. What is standing out to you when it comes to what's driving the sell-off here and any potential for recovery?
I'm much more focused on the DeepSeek issue than I am on the tariff issue. And the reason for that is, and we've seen this, the way in which the tariffs have started to be rolled out have been in fits and starts already, right? And there's been a lot of posturing and then a pullback with negotiation. And tariffs can be changed, not quite on a policy whim, but pretty close. The emergence of DeepSeek waking up the market and say, hey, guess what? Perhaps there's a way to get more of these big models, more of this groundbreaking AI work done more cheaply, I think has really forced analysts to go back to the drawing board and say, are our assumptions around cost efficiency correct? Now, on the flip side, and this is where I think CEO of NVIDIA, Jensen Huang, is just such a fantastic communicator. He did come out, do you remember, on earnings day and say, no, look, this was actually proof that for every dollar the hyperscalers invest, the productivity is going to be greater, which makes it even more attractive. Yes, of course, from a return on investment a perspective, that makes a ton of sense. But we don't really know which way it's going to land quite yet. And I do think sometimes we talk about what's the catalyst for a market move. Sometimes it's just something that forces folks to go back to their assumptions and question, is what we thought was the case really the case anymore? And to me, DeepSeek was that moment.
And I wonder how you're thinking about, okay, let's say AI is cheaper, right?
Yeah.
And that means that, you don't need the best GPUs in the world from NVIDIA, and that weighs on their margins. What about the fact that Jensen Huang, you just think he's a good CEO, and maybe there's growth when it comes to robotics, maybe there's growth in self-driving cars and other forms of automation. Is that enough of a bull case for investors in NVIDIA?
The physical AI, right? That's what he's come out and called it. I think right now people are saying maybe it is, but I don't know. And I'm re-underwriting, and I'm taking the new data, and I'm starting to look for new facts, right? I think it's only now that the market has said, okay, well, we better go check out that thing that Jensen Huang talked about, which is things like robotics. And you're starting to see more of that narrative come into play. But if you look at what's happened, TSMC, as you said, Madison, had pretty good news out today, up nearly 40% revenue for the 2 months so far this year, but the share price is down. Right, so I think if you look at ARM, the share price is down year to date. I just think that there's a real re-underwriting going on right now, and suddenly other parts of the economy are looking more attractive, like defense, for example, as Omar, our guest, just said, other parts of consumer staples. So I think we have to wait and see.
Yeah, seeing a lot of momentum unwinding happening under the hood of the market, and it's really important to take a look at those semi stocks.
NVIDIA's share price increased by 2% on Thursday of last week after Morgan Stanley reaffirmed its top pick rating for the company, seeing the DeepSeek sell-off as a buying opportunity. Long-term challenges are acknowledged by analysts under the leadership of Mr. Joseph Moore, but the immediate business outlook is unwavering. The company's Q4 2024 earnings call revealed $39.3 billion in revenue. NVIDIA is a key player in AI and serverless computing thanks to its hardware-software integration, especially its DGX cloud solutions. According to the CEO of the company, their product performance has improved by millions of times in the last 10 years, and they anticipate further growth in the upcoming 10 years. In addition to its well-established dominance in hardware, it is also very prevalent in the cloud. The company's hardware powers 93% of GPU-accelerated instances. NVIDIA is a member of the Semiconductor Industry Association, SIA, which discussed the significance of the U.S. Trade Commission looking beyond tariffs and collaborating with international partners to counter China's ambitions to dominate the market. Like with other cutting-edge technology, China has implemented a number of laws and policies aimed at making it more difficult for foreign businesses and goods to enter its domestic market. In order to encourage local producers and design in domestically produced semiconductor chips into downstream products for sale in China's domestic market, as well as for products exported to the rest of the world, the government offers a variety of subsidies, discriminatory standards, preferential government procurement policies, local content requirements, and other measures. The price of NVIDIA's shares was $110.83 at the time this video was made, and the consensus price for the next 12 months was $172.22, which is a 52.83% increase. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
We continue to follow the story of the sell-off that we saw. First of all, the whole year has been quite volatile. We had a big sell-off yesterday, and we continue to break below those levels of yesterday, and today we have lower lows. So it's time to talk technicals, and joining me now, very happy to have with me right here on set, Katie Stockton is here, CMT founder, managing partner at Fairlead Strategies, and portfolio manager for TAC. Thank you so much for being here.
Of course.
Katie, glad you're here because we were just talking about some of the levels, and today, we broke yesterday's lows, and that's something people watch, especially after we hit the 200-day and we're below that.
Well, lower lows, like you said, that is problematic. It does reflect negative short-term momentum. We also have very weak intermediate-term momentum, and I think that's the bigger issue here. I do expect to see a snapback that should present a better selling opportunity, but I would think about the next snapback as exactly that, because when you take a step back and you look at the major indices like the S&P 500, you'll see what looks like a double top formation, like the shape of an M. And that's when you have an unsuccessful test of resistance at the highs, and then a breach of support. In this case, it was right around the January low. So it gives us the sense that we have a bit of a toppy market right now. We've been calling for more of a choppy year overall, and I think this is just part of that, right? It makes it much more difficult to take advantage of trends.
So more of sell into rallies than buy on the dips right now would be your advice.
Yeah, until we have evidence that an intermediate term low is being established, not just perhaps a short-term selling climax, which there are some minor indications of, not fully convinced of it quite yet, but enough to suggest that we don't want to sell into this downdraft. It's really rarely ever the right thing to do. Patience is warranted. But because the intermediate term gauges are still pointing lower, I think there's still some risk.
And you make a good point, because when we look at the Mag 7, some of those names that, and we're going to talk more about tech in the next segment, but when you see names down 10, 20, I mean, Tesla's down 50% off its highs, but it's for the number of days that they sort of linger there in that intermediate term and just can't bounce back, right? I mean, that's a very telling story, and Citigroup is noticing that today.
Yeah, it feels like a movement on the charts from what was a secular and cyclical bull market to now maybe a trading range for some of these names. The underperformance is really very pronounced. We saw the ratio of a Mag 7 proxy to the S&P take out its own 200-day moving average, and that suggests it's somewhat meaningful. So I think we'll see at least inline performance at best, if not more underperformance from the Mag 7, and of course therein that creates a more difficult tape.
Yeah, I'm looking at your Fibonacci retracement levels here. So tell us where you are watching for us. Right now we're at 56.06. We've come up off the lows of the day. I think the low today was 55.49. Your thoughts on what levels are key in your mind now?
Yeah, and we like to combine the levels with the indicators. The levels would give you a sense of what downside risk might be. Assuming that we see a weak finish to this week, which would confirm last week's breakdowns, then the next support for the S&P 500 becomes about 53.65 to 53.85 in our work. And that's based on a Fibonacci retracement level, as you mentioned, not to get too technical, and also something called the cloud model, which is also known as Ichimoku. So these are two metrics of support that we find pretty reliable. It doesn't mean that that has to be a magnet for the S&P 500, but it does give you a sense of what downside risk might look like.
Right, understood. But we could find some support. As we had a guest on today who said I would start buying. First he said below 5,500, and then he said I would buy at 5,400. So I wasn't 100. I mean, I was writing at the same time. But the point is, people are waiting for it to go lower.
I think what we should wait
when to step in and buy.
Right. To wait for the indicators to look better would be key, in my opinion, and not just the short-term metrics. Take a weekly bar chart and make sure you have an oversold reading and a subsequent stabilization phase to show improved momentum. That would be more convincing as it pertains to a tradable low. And we do feel like this next low that we will establish likely in Q2 could serve as the bottom boundary of a range-bound tape.
Well, I mean, that would probably be very reassuring for folks. They don't want to see it fall further than that.
That's right.
They could probably handle that.
According to Gartner, the worldwide semiconductor business generated $626 billion in revenue overall in 2024, an 18.1% YoY increase. With revenues that then doubled from $64.8 billion in 2023 to $112 billion in 2024, data centers were the second largest semiconductor market after smartphones. According to the International Data Corporation, the demand for semiconductors will increase by 15% worldwide by 2025. The performance of the U.S. semiconductor industry has a big impact on the whole economy, making it an essential part of the worldwide technology scene. The sector has grown and faced difficulties in recent years due to a number of causes. Analysts claim that the growing dependence on technology across a range of industries, including artificial intelligence, consumer electronics, automotive, and healthcare, is what is driving the growth. Due to businesses' significant investments in R&D, the sector has been at the forefront of technological innovation. As a result, more sophisticated chips with improved performance and efficiency have been created, including ones that use novel materials and smaller manufacturing nodes. The need for increasingly sophisticated semiconductors is still being driven by the speed at which technology is developing. As previously said, the emergence of artificial intelligence, AI, and other cutting-edge technologies is especially significant as these applications call for high-performance chips, which American businesses are well-positioned to supply. In the very competitive semiconductor sector, foreign businesses, especially those in Asia, present a serious threat to American firms. Price pressure has intensified as a result of this competitive climate, and innovation is now even more necessary to keep a competitive edge. Geopolitical tensions, especially those between the United States and China, are having an increasing impact on the business. The semiconductor industry is facing uncertainty and difficulties as a result of the ongoing trade tensions between the United States and China. Trade and investment restrictions brought forth by these tensions have the potential to upset supply networks and hinder U.S. corporations' access to markets. They have, meanwhile, also sparked initiatives to expand local manufacturing and diversify supply chains, which may eventually help the U.S. semiconductor industry. The semiconductor industry's strategic significance has been acknowledged by the U.S. government, which has taken action to encourage its expansion. An excellent illustration of this assistance is the CHIPS and Science Act of 2022, which allocates substantial funds for domestic semiconductor research and manufacturing. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.